We've got more first quarter earnings rolling in from the US banks. Bank of America and Citi both posted better than expected numbers. Let's break it down for you with Mike Clare, Senior VP and Senior Portfolio Manager at Brompton Funds. Great to see you.
Yeah, great to see you as well.
This has come up obviously with on every segment with US banks. It's kind of the calm before the storm, isn't it? Because we don't know the impact on the economy of the tariffs yet.
Right. I think what we've seen so far this quarter is a pretty strong quarter. Like all of the large banks have reported now, we've seen pretty strong quarters across the board, which is a continuation of a trend we saw in the second half of last year. But notably, the outlook is, of course, a little more uncertain, and that's being recognized by management teams on conference calls for the banks.
So far, how are the loan loss provisions from the big U.S. lenders?
Yeah, so loan loss provisions, I think, look pretty good so far. I think that reserves have been already built up to pretty fairly appropriate levels. You are seeing some banks start to indicate, factoring in a potentially weakening economy into their provisioning. So JP Morgan, when they reported on Friday, for example, spoke about, they have different models for the economy. They talked about increasing the probability of their downside model. And that would have resulted in, their unemployment forecast going from 5.3% in the U.S. to 5.8%, and that's reflected in higher provisioning for the quarter.
Oh, so they took higher provisions
They
already.
did take some higher provisioning, built some of those reserves. We haven't seen that across all of the banks. Notably, Bank of America reporting this morning kept the reserving in line, but they also have gone, I think, out of their way to highlight the quality or the credit quality of their loan book. They're a little more consumer-driven on the loan book versus some of the other banks, and they were highlighting some of the high credit scores among the portfolio in particular.
Just stick with Bank of America. It is a stock that you own, and for one thing, capital very strong. The balance sheet very strong at Bank of America.
Capital is very strong, so they've got a CET1 capital ratio about 110 basis points above their regulatory minimum. And what that's driving is, as they continue to generate pretty strong earnings, that's driving their ability to pay out dividends and buy back stock. And so during Q1, they paid dividends of $2 billion, and they bought back about $4.5 billion worth of stock. You add that up and annualize it, that's nearly a 10% total shareholder return they're providing to shareholders. And so, I think they had some comments on the call that they expect that pace of buybacks to continue throughout this year. And we think as long as they're able to generate strong earnings, which admittedly the outlook is a little more uncertain, but as long as they generate those strong earnings, then I think they'll be able to continue to buy back stock and drive value for shareholders.
And we have heard a lot of talk that under the Trump administration, we'll see looser regulation on banks. So that presumably will be a bonus.
Yeah, I think all of the banks, if you listen to their conference calls, they seem to be providing messaging to the administration that they really want to see this regulatory reform that they've been promised come down the pipe. Even, some of the banks, Jamie Dimon in particular, talking about the supplementary leverage ratio, which wouldn't actually help JP Morgan, but may help with Treasury market liquidity. So I think they're highlighting those types of things that they want to see that may help with the overall economy. Ultimately, I think what the banks would like to see is changes to things like this stress capital buffer, which is a buffer they keep in their capital levels based on their stress test results. And one of the challenges with that is it tends to move around each year. And so it's hard to plan for, and it means banks have to hold excess capital above their minimum levels in case that number goes up. And so I think there's still this regulatory reform coming. Treasury Secretary seems pretty optimistic on that in particular. So we'll see. But everything remains uncertain with this administration, of course.
Yes, that's right, putting it mildly. Talk to us about Citi. Again, total dividends and buybacks working out at a total shareholder return of greater than 9%. Over what period, though?
So that was just taking the Q1 number and annualizing it. Assuming they do that for the year, then they're going to be similar to Bank of America at just under 10% total shareholder return.
Right.
What we really like about Citigroup here is, so number one, it trades at a discounted valuation. And so it trades at about 70% of tangible book. So as they're buying back that stock, they're doing it at a discount to their tangible book value, which provides value accretion to the shareholders. Ultimately, we think they have pretty good potential to continue to drive strong performance, and part of that comes from the operating expense line. Notably, we saw operating expense this expenses this quarter come in below expectations. They're, of course, midway through this restructuring plan that they launched a couple of years ago, where they're looking to reduce headcount by 20,000 employees. They're reducing the number of management layers from 13 down to 8. And so as that continues, we're going to see them continue to drive pretty strong performance, gradually get towards their 10 to 11% return on tangible equity target.
Still sounds like a lot. 8 layers of management.
Still sounds like a lot, but these are massive businesses with many different divisions operating all over the world. So I can't imagine they're easy to manage.
If you had to do a pair trade here and go long Bank of America or Citi, is there any US bank that you'd be tempted to short just as a pair trade that you think may be overvalued?
I don't think, I don't think that I generally like the banks here. I think I would give a slight nod towards Citigroup just because it trades at a discounted valuation. And I don't think the market is recognizing their potential to continue to drive earnings growth, even if the economic environment deteriorates somewhat. But ultimately, I think what we've seen over the past few weeks with the market volatility is we've seen the banks sell off to attractive levels. I still think that the market, to a certain extent, may have some PTSD from the financial crisis in 2008, 2009. And what happens when we get these types of things like COVID or tariffs is the market sells banks. But we've seen, since then, these have become much more stable and much more safe businesses. We saw that through COVID, and I think we'll see that again here through all of this tariff and trade uncertainty. And so we do like the sector broadly here.
That's Mike. Thank you so much, Mike. That's